Good afternoon, ladies and gentlemen, and welcome for the third time for this special series of Market Masters, which we are utilizing on the day after the budget to analyze the document in great detail, bring you views from the best brains that there on the Lal Street, and help you make more wealth in both the short term and the longer term. Our guest today, ladies and gentlemen, is Mr. Mihir Vora. He is the Chief Investment Officer at Trust Mutual Fund, a person who's seen markets over the last 2.5 decades and has helped his customers on the financial side to make lots of long-term capitals, long-term wealth creation. Namaste Mihir Bhai, very warm welcome from my side and Sakshi's side on Market Masters to you. As usual, we'll be discussing the budget document threadbare. Let's start with what you like. What do you think is the main context of the budget? What is the document aiming at, and how far has it reached in achieving the aims that it set out to?
Certainly. Thank you, Shail, and thank you, Sakshi, for having me. First, we'll start with the positives, as you asked. We should always start with the positives.
Yes.
The thing is that the biggest positive is that the urge or the pressure to be populist was not followed, which is good. And I think the way the fiscal deficit has been targeted to be reduced to 4.9% should give a lot of confidence to the global bond investors, to the global rating agencies, that India is serious about being a responsible economy. We are not a banana republic. We are emerging market, but we are a very responsible and one of the strongest emerging markets. And that should feed into FDI flows, FII flows, bond flows, of course, which we are expecting significant this year, and most importantly, to the currency stability. So India will be one of the fastest growing economies with a very good macro and a very stable currency with almost 7% interest rates on the 10-year bond yield. So this combination should be very attractive for any global investor to put money not only in equities, but also in fixed income for India. So that's one of the key positives, I would say. Second is there is good thinking on job creation. There is a significant, scheme. There are many schemes for employment-linked incentives for companies who are going to take on trainees. There's a lot of first time we've seen a significant commitment to internship and training skill development initiatives. A very good focus on energy sector, especially the renewable space, where we see almost a doubling of the resources dedicated to renewables. Good support from MSME through various schemes of credit enhancements, etc. So I think all in all, this is a budget, I think, with a longer term focus, I would say. And the urge to be populist has not been, followed, which is, I think, a good highlight.
Mr. Vora, a very good afternoon to you, and thank you so much for being with us. The one thing that I wanted to understand from you is, right now we are seeing a negative sentiment due to the rise in taxes across equity, STCG, LTCG, STT on F&O. How long will the market take to completely digest this and then move on?
Maybe a week or so, I would say. For example, in 2018, when we did see some hike in the taxes, the markets did react over a few weeks. So maybe the reaction may not be immediate. But I think that time the difference was the increase was quite significant. This time it's only 2.5%. So from 10% to 2.5% on the long term side. So not a big deal. What I would be very interested in watching is after October, what happens to the F&O volumes, because the STT increase is in terms of percentages, it's quite steep, almost it might look like 0.06 to 0.01. 0.006 to 0.1, but if you see the transaction cost, they actually go by almost 60% on the F&O segment. So how that impacts volumes in the F&O segment is something that we need to see, but that of course will be effective from October. On the long-term capital gains part, I don't think it's so much the quantum of capital gains that people are worried about. It's just the fact that what next? Will it go to 15%? So that lingering doubt and the fact that, how long will you keep taxing the middle class and equities, which is providing such good resources for entrepreneurship and for growth in the private sector. So that little bit of disappointment is there on that side.
Mihir bhai, what is the thought process in Delhi that on behalf of the government, it's the investors and traders who've bitten the bullet, this being the first year of the third term, and then over the next 4 years at least, they will not tinker with capital gains and long-term changes in the way profit is taxed.
Over the long term, we can argue that it was 0% in 2012.
I agree with you, Mihir bhai, but the problem is that for investors such as the viewers and for fund managers such as you, we have to live with what the government does. We may feel bad, and of course there is this widespread anger which is visible in all sorts of WhatsApp groups where the STT was put into place to replace the capital gains tax. Forget removing one or decreasing the other, you have increased both. Abhi ab kiya kya jaye? You see the anger that's getting reflected on Bank Nifty, it's down 1.5%. It might be, might be, related to end of account. But we know it in our conversations with friends across the market that this has not been appreciated at a time when all sorts of sops have been given to Andhra Pradesh and Bihar, and they have been funded by the capital markets.
Yes, and the funny part is I don't think the quantum of capital gains tax that will be incrementally collected is that significant in any case to make a difference to the budget, frankly.
Mihir sir, do you also see a time-wise correction now taking place beyond the budget? We have seen a one-way move. Are we going to be entering into a long time-based correction right now, or do you think the markets will be swift to recover and be on an onward and upward journey again?
See, I think the most exciting segments which were there, where we saw a lot of price appreciation in the last 6 months or so, with the high growth segments like the cap goods, the infrastructure, the renewable space, the defense, railway, all those stocks with good reason, of course, did go up a lot. In those segments, I think there can be some time correction or even some price correction for a period of time, because the way the valuations had come about, probably we are discounting a bit too much in the future. So we could see some kind of a breather there. And more importantly, at certain valuations, you need something extra to keep the momentum going if you are to take it to the next level immediately. Of course, with time correction in the next 1-2 years, of course, the valuation will catch up because earnings growth is still visible. These are segments where we see 20, 30, 40% earnings growth. But the point is that from a 40 PE, if you want to take it to another 10, 15, 20% up, then you need something extra. And the thing is that while the budget has maintained the capital expenditure for most of the segments at the same level at which it was projected for the interim budget, there was a leeway to maybe increase it a bit because of all the factors that we know. RBI dividend was a pleasant surprise on the positive side. Direct and indirect tax collections have been better than expected. Nominal GDP growth is likely to be better than projected in the interim budget. So there were enough levers or enough indications to be a little more optimistic, and taking into account those, there was some scope to increase capital expenditure, which didn't come forward. So that was, I think, I wouldn't say a disappointment, but probably a missed opportunity to give the right signal in those segments.
Okay, Mihir, we've done with the how should I say, the macro dissection of the budget, but for fund managers like you, you have to analyze the document and start making money after the minute it's uploaded. And as luck would have it, this is the third month for you at Trust, and the FlexiCap scheme has gathered 650 crores. This is the maiden product that you have so far. Now, with this background of budget behind us, as also the national elections. What now? What are the kind of stocks you are looking at or sectors that find your attention given the changes that have happened in the budget?
So based on the budget, we are not changing too much, frankly speaking. Probably add a little bit on some of the FMCG stocks where we are underweight on. So maybe reduce the underweight a little bit on the FMCG side. But in general, over the past few weeks, we have been reducing some exposure to some of our favorite themes where stocks had gone up a bit much, especially in the industrial space, the cap goods and industrial space. So we were quite overweight and we continue to be overweight on the sector. But there were some stocks which probably overshot a bit, went up too fast. So we are booking some profits on that space. Otherwise, in general, we like the broad theme of financialization of savings. So that's basically wealth management, asset management, those kind of names where we see a secular long-term path of growth. Some of the financial distributors, for example, they are all linked to basically the increased penetration of financial services and savings instruments like mutual fund, insurance in the middle class and in the rich segment. So financial savings is something that we are positive on. We like the premium consumption space, not the low ticket items in FMCG, but premium discretionary items. We like the premium consumption items also, so to say. Capital goods and a little bit of overweight, I would say, on healthcare. So we are underweight on utilities. We are underweight on the materials and energy space. We are underweight on FMCG and we are also neutral to underweight on IT because FMCG and IT, we do believe that these are not really high growth sectors. These are sectors which are showing just single digit kind of growth, which is probably not in line with our core philosophy of growth at reasonable valuations philosophy.
Mr. Vora, what about PSUs? They've been the darling of the D Street, the higher flyers. Of course, the first knee-jerk reaction is being seen across the board. But is the bull run in PSUs over, or will it still have some more legs after this consolidation?
We have exposure to PSUs, but again, only in those segments where there is growth or there is visibility of growth. So, for example, when I say we are underweight on materials and energy segments, we don't own any PSU in the energy segment. So, no oil marketing company, no exploration oil company or coal company for that matter, because it's more a function of the sector and the sector stock dynamics rather than it being a PSU, I would say. But we do have PSUs, for example, in the defense space. Where there is good visibility of growth. So I'm not treating PSUs as a separate asset class, but looking at it more from the sector and stock perspective.
That's an interesting point you mentioned that, just 2 months ago, the rally in defense PSUs sort of went into that parabolic phase. Garden Reach going from 800 to 1700, Masgaon moving from say 2400 to 3500. I think that was a sweet spot when the investor money came into Trust Flexi Cap. So great timing and great luck, and often great timing and great luck only come together when you do a lot of homework. So I'm sure that's been something which is extremely beneficial to the unit holders of Trust Flexi Cap. But interesting that you mentioned, Mihir, FMCG, something that's making a comeback after 3-5 years and absolutely no change in valuation. It's just a time correction that has happened, and people are now probably looking at an alternative to the kind of money that they've made in railways, PSU banks, to a large extent defense as well. What do you like in FMCG? ITC at a record high, Britannia at a record high, Godrej, Dabur, Marico, these were old world favorites.
So we have a couple of names in FMCG, but overall we are quite underweight on the sector. But of course, it's a big sector, so there are always stocks to choose from. Stocks with business models which probably help them to do well in spite of headwinds. We have a couple of those stocks in the FMCG segment. But in general, if you see, the large categories are fairly penetrated. And a lot of the earnings growth that we saw in the last couple of years did not really come from volumes. It has come from margin expansion. For example, the couple of toothpaste companies, etc., where the earnings growth has come, but you hardly see any top line growth, and it's the case in a lot of the highly penetrated categories. So we would prefer to have stable margins and good volume growth, because then the trajectory of growth becomes more predictable for the medium term, for the long term. Where you see a one-off kind of a 1 year or 2 year margin improvement, that may not be sustainable, because unless the segment is growing, unless your business model is enabling you to penetrate more customers and markets, how long will you keep milking the few set of customers? So unless there is volume growth or at least visible earnings growth, we are not very comfortable, and we don't want to take a very long-term view. Of course, from time to time, when you want to go into some defensive mode, etc., we might add exposure. But within FMCG, we would still prefer stocks where there is a lot of visibility of earnings growth. So typically, these happen to be some mid caps, etc., where the business models themselves are robust enough, or the market is still under-penetrated in that particular niche, that you can find big stocks with visibility there.
Okay, Mr. Vora, another thing is that how have you read into the real estate sector really? Many people are seeing this as a glass half full, half empty kind of a scenario. There has been the urban outlay, SOPs for REITs also, but on the other hand, the indexation benefit that has been taken away. Real estate sector has been an outperformer among sectors in the last 2 years per se. What happens next here?
So I think real estate segment will not be impacted by the capital gains tax changes, frankly speaking, because there is some impact, but it's a marginal. I think as long as we are creating jobs and we are creating wealth, it should be fine. And especially if we are talking about the listed players, most of them are focusing on the premium end of the market. So all the growth that we are seeing in the listed players essentially is a reflection of the K-shaped recovery that we are talking about at the higher end. And to some extent, it's that K-shape is a function of industrial growth, is a function of capital markets growth also, because a lot of the profits that people are making in their ESOPs, or even promoters making money in their stocks, and of course investors gaining because of market cap increase in any case, and the stocks portfolio as well as mutual fund portfolios have done very well in the last 5 years. So that wealth effect is also creating a lot of demand on the real estate space as far as the listed players are concerned. So I don't think this bullishness in real estate is purely a function of the overall economic recovery. I think as of now, it is more of a white collar or a K-shaped recovery. And we are hoping that the lower end housing also now will pick up. Though in the budget, there are some SOPs for the low cost housing, etc. But I don't think it's anything that can move the needle in a big way for most of the large listed players. The large listed players will still continue to be beneficiaries of the premium consumption.
Absolutely. If you look at the housing expansion, about 58% increase has come in on PM Awas Yojana to about 85,000 crore rupees, and that's getting reflected at least in a lot of rural focused stocks. Mihir, if we dig deeper, one of the most outstanding how should I say, standouts as far as this budget is concerned is this thrust on employment and getting youth back into factories, getting them to have internships, and also adding something to their monthly kitty. Do you think that will spur some kind of personal consumption? We see cigarette and liquor stocks going up. Sakshi and I were wondering how can there be a party with this kind of capital gains tax, but we somehow figured that we can link it to this emoluments, 3,000 rupees extra per month that they will get paid. Are fund managers thinking that way?
No, I think it's a very tenuous connection, I would say. I would not really bet a big deal on it, but it certainly does improve the ease of doing business. It certainly does make it more attractive to hire labor and train labor. And the fact is that the economic survey, if you see, there were a couple of things that were very starkly mentioned in the survey. there is a sense of disappointment in the government about private sector capex happening or not happening rather. So economic survey has repeatedly mentioned 2-3 times. I read that now it's the onus is on the private sector to start investing. And the economic survey also mentions that we need to create 80 lakh jobs a year if you were to kind of keep the youth gainfully employed. So I think whatever you do for training and job creation is going to be less. So the more the focus, the better. And I think this is a step in the right direction. And the point is that we need probably to do a lot more of this because not only labor, but we need skilled labor. A lot of the graduates which are coming out of the system also are unemployable because the training and the education quality is so poor. I think we need to not only focus on quantity but also on quality, and this training initiative, apprenticeship initiative, will certainly help in the skilling of the labor pool.
Mr. Vora, as we look forward now, three of our big events of this year have already been done and dusted. 2 budgets and 1 election as well. What next?
Yeah, I'm glad because the election and the budget have happened just within 2 months of my launching the fund. So it's been a very eventful 2-3 months for me. I need to take a breather now as far as decision making is concerned.
Absolutely.
Actually, Mihir bhai, let me confess this online. Sakshi and I were discussing exactly the same thing before we started this show. Ki bahut ho gaya. We need to sort of exhale, and everybody on Dalal Street needs to exhale, including stocks. बहुत काम कर लिया 18-24 महीने, and last 7 months were like Vande Mataram Express doing a rocket kind of a maneuver.
Now, Mr. Vora, I wanted to ask you what next for the markets will be the big trigger that will pull it out of consolidation and again look forward.
See, the ultimate trigger is earnings, and for example, if you look at the Nifty earnings, they are likely to be about 12 to 14% earnings growth for FY25, and similar number for FY26. If you look at the small cap indices, the earnings growth is a little higher. So we basically need to just keep identifying the right stocks and sectors. Because we almost have 1,000 stocks to choose from, frankly, if you look at the large, mid and small categories, and if you filter for quality, etc., the universe is almost 700 to 1,000 stocks. So we will always be gainfully employed. There will always be opportunities to pick and choose stocks from. And I think we can still make money in the markets if we do the right things continuously. At the index level, of course, there may be periods of consolidation, there may be periods of correction also. But if you then drill down into any sideways phase or even in a bear phase, there are always a few stocks and sectors which have given positive returns.
Fair point. Mihir, there hasn't been any sectoral direction given in the budget which could be deciphered in a way that might help in stock picking. So earnings, but this second quarter earnings that are upon us hardly have shown any improvement or any signs of improved traction on either margin or profit. So how are fund managers now thinking in terms of the next probably 9 months or 15 months in terms of stock picking? Are you again on that relative valuation chart कि भाई थोड़ा सस्ता हो गया ये वाला stock पिछले 6 महीने से तो इसको खरीद लो, or is there some more logic going into it? Earnings are not showing any, I mean there are more red flags than green.
Certainly, and which also is an extension of what Sakshi just asked, about the sideways correction or time correction. So, the results so far for the June quarter have been a mixed bag, frankly. There have been fewer positive surprises than meeting expectations or negative surprises, I would say. So results have not been that great, frankly speaking. The big tailwind that we had last year was on margin expansion. So even though there was little volume expansion in a lot of the segments, because of margin expansion, we saw very good profit growth for FY24. But now that has also corrected. So the lever of margin expansion probably is much less now or much smaller. And we need now volumes to pick up. And so far in the first quarter, if you see FMCG results, etc., that's not the case. Even in IT, for example, while there is some improvement in the guidance by certain companies, we're still talking about low single-digit growth for most of the large companies. So I think that could also be one of the reasons why at the index level you might not see large returns, and you'll basically have to go down to more specific stock-related stories.
But would you say, Mr. Vora, that we need to now temper down our expectations in terms of the Nifty gains for this year, FY24, 2024 calendar year and FY25?
Absolutely. So if we are able to get low double-digit returns for this year, I think that should be a good achievement at the Nifty level. Of course, stocks can do much better, etc. But at the large cap index, which is the Nifty level, I would say a double-digit return should be a good aspiration.
Mihir, our final question to you. Yesterday's buying into the dip, as also the June 4th purchase of that very sharp downtick on equity prices is as much a learning experience for all of us as is the potential of the Indian market. I think retailers have sort of decided that we will continue pouring in money, and with that kind of monthly SIPs or ultra HNI kind of an input, you have about a conservative fresh 50,000 crore rupees coming each month. On a broader understanding, do small caps and mid caps continue to make sense, or will all this money or a large chunk of it get into large caps?
I am of the barbell kind of camp. I would say that if you look at the Nifty 50 or the top 100 stocks, valuations there are not crazy. They're still reasonable. If you look at the small cap universe, which is beyond the 250th stock, the first 100 being large caps, next 150 are mid caps. So first 250, if you go beyond the 250, which is the large small cap universe, I think there is enough stocks to choose from, because most of the exciting segments and stocks that we are talking about, which are likely to be long-term high-growth segments, those typically are represented better in the small cap or to some extent the mid-cap universe. So I think this, I would say that, on valuations-wise, I would go for the large cap universe, but stock picking-wise, I would go for the small cap universe. It's this middle 150 where I think there is a bit of a kink in valuations, because a lot of the say flexi cap money or mid cap fund money or even the multi cap money has to perforce go into these 150 stocks where there's kind of a crowding out, so to say. So I'd say aggregate level, if you see these 150 mid cap are a bit more expensive, but there's a lot of scope for stock picking in the small cap. So I would say some large cap and some small cap. That's what it looks like.
Thank you so much, Mihir ji. We look forward to also analyzing your third portfolio post July 30th. And I'm sure there will be some great gems that Trust Mutual Fund has picked up. They have a phenomenal investment thesis and a great investment philosophy. And based on that, the stock picking will be phenomenal. We look forward to that portfolio, Mihir. And thank you so much for your time. I hope you enjoyed the conversation as much as we did.
Certainly. Thank you so much, Shailendra and Sakshi.
Thank you.
That, ladies and gentlemen, was Mr. Mihir Vora, Chief Investment Officer at Trust Mutual Fund, expressing his thoughts on the National Budget document that was unveiled yesterday. Sakshi.
All right, viewers, we'll wrap it up at that on this very special edition, but do stay tuned as action continues. We're getting you a number of market masters to share their views right after the budget and what its impact will be on the markets, on the economy and your investments and strategy that you should be following. So stay tuned.